We have to think about a couple of things with plant assets because they have such long lives that depreciation will affect your income taxes, and selling them can create a gain or loss. So these are things that we're going to deal with in the upcoming slides. Most companies use straight line depreciation because it's the easiest one to use. The government allows you to use accelerated depreciation because it allows for greater depreciation in the early years. And a lot of companies that are just starting up, this is good for them because they can get the tax benefit from them. This slide illustrates the modified accelerated cost recovery system. Actually, it doesn't. This shows cash advantages. This does. This is set up by the government. They send out a chart every year to companies that tells them what year an asset belongs to, how long they should depreciate it for, and then the method they should use for depreciation. So they don't really even have to calculate it themselves. They just can kind of look it up. Partial years is another thing we have to talk about. It would be great if everything was purchased at the beginning of the year, but we know that this doesn't happen. In this example, FedEx purchases a warehouse building on September 1st. So they will want to record depreciation for September, October, November, and December. Using straight line depreciation, you simply calculate for the year and then divide that amount by 12. Multiply it by the number of months. So in this case, they just multiply by 9/12 to get an amount of $15,750. This is the yearly, and this is the partial. With units of production, you don't have to do anything different because it's based on how much it's produced. And with double declining balance, you'll do the same thing that you've done with straight line, just using the number of months that the asset has been in use. Sometimes after it's been used for a while, we find that it will actually last longer than we expected, or maybe we can use it more than we actually expected. This is called a change in accounting estimate. Depreciation is an estimate, and as such can be changed over time. There's going to be a change in useful life at this point in time. The asset had a book value of $30,000, I believe here. Company expects it to last another 10 years. So $30,000 divided by 10 gives you new annual depreciation of $3,000. This is your journal entry. We don't go backwards. We continue on from this point. An asset that's been fully depreciated means that it can still be in use, but no longer will we record any depreciation. When we're totally done with it, we will dispose of it and remove all of the accumulated depreciation and the asset from the accounts from our books. The next section is complicated, so that will be another video.